Hey, good morning, good afternoon, and good evening, and welcome to the Therapy Matters podcast, your one-stop resource for expert insights and advice on everything therapy and rehab. Good to be with you again. I'm your host, Scott Rongo, and today I'm joined by John Caselli with Serent Capital. John, thanks for joining the show today.
Thanks for having me. Couldn't be more excited to chat to you about therapy and rehab.
Awesome. Hey, John, maybe for a little context, it'd be good for you to do a brief introduction of yourself for the audience.
Sure, happy to. So quick background, I've been with Serent for just over 10 years, and inside of Serent lead our broader healthcare platform. We've been active investors in healthcare for since the start of the firm, and I've had the good fortune of leading it over the last 7 years.
That's awesome. Well, I think you were certainly will be able to give some good insight and perspective to the conversation today. You know, as an investor in the physical therapy space and in healthcare in general, I'm sure you can attest there is just a ton of activity that's happening and in healthcare, but particularly in the PT space. Feels like we're hearing of acquisitions that are taking place, both big and small, just on a monthly basis. Would just love your perspective overall on the market and where it's been, where you think it is, and perhaps where it's going.
Sure. Well, I won't venture a guess at where it's going because in some respects, that's a very difficult thing. But I'll chat a little bit about where we've been and where we are today. And I think if you look at the last 2 or 3 years, right, it's been the era of free money, and so the multiples and people's willingness to really bend over backwards to use acquisitions for growth has been incredible, and they were able to do that through cheap debt. And at this point, we're really kind of seeing, and I'll call it more of a, it's a return to normalcy is really what I would phrase it as interest rates have risen. And so a lot of the consolidators inside of the market who've taken on debt just have less ability to keep acquiring new companies. And so there's a little bit more of a premium on quality. People are looking for really great assets and companies to partner with. And those ones are still commanding really healthy multiples. But businesses that are maybe not quite as high quality or even lower quality are generally kind of just being shunned.
Mm. So, it's interesting. If you were a practice, right, and you were really looking for to have some kind of an exit, right? What are the questions that you would ask yourself, and what are you looking for in that conversation to get started?
Yeah, and I was just sitting and reflecting on what you just said, and I should say, people are still active, right? And so it depends a little bit on what you want to do. But if you as a practitioner or an individual is thinking about selling their practice, there's still a really robust, healthy market there. And so while I say it's a return to normalcy, I don't want people to fret and think that, gosh, nothing's going to get done. But it is a tougher market than it once was. And you're asking the right question there, Scott, which is, how do you evaluate what to do as an individual and who to partner with, which is a little bit of the question. And I think there's kind of 4 fundamental questions whenever you're considering a sale of really any business, but in particular, I think it's incredibly important when discussing a practice. And so, the first one is what will I make a little bit? I think there's always that kind of question. It's a simple one, which is just hey, how much money am I going to make in this? 2, and I think this is a really important. What's going to happen to my patients? I think almost every practitioner I know deeply cares about the outcomes of the individuals they serve, and so having a good understanding of what's going to happen to your patients is kind of number 2. Number 3 is what's going to happen to your employees. You probably built a strong culture that's attracted great talent. There's people that you really care about inside of there, and having an understanding there, I think, is critical. And then last, and this is an interesting one, is what's going to happen to me? And it's a really interesting question because depending on who's acquiring you, there's kind of different outcomes for you as an individual. And so those are the four kind of key questions that I would rest on. We can dive into any of those if you'd like, but I'll stop there.
Yeah. No, that makes sense. And I would also think about, as you think about maybe those four questions in your mind, right? What's the, what do you make the evaluation, my patients, my employees, and then me? You probably have to also start thinking about, well, what kind of investor are you looking for, right? Are you looking for a strategic investor, right? To where you want to be more involved, right? Have significant impact on you and what that can maybe look like. Or you straight looking for a financial investor, right? To where it allows you, give you a little bit more, ownership of what you might and where you might take the business, and have more say so for for yourself, your patients, your employees, across the board. So it sounds like, as much as you ask those questions, you also have to be thinking about then what's the type of buyer or the type of investor that you would want to partner with.
Totally. And I think it's an interesting. I would tell you that the four questions we laid out feed into, like, if you can answer those four, you'll come to an answer of what type of investor I would like to be a part of. And you kind of hit the first one on the head, which is, do I want to be acquired by a larger consolidator? And there's a bunch of really good, large, practice chains out there that have tremendous care and that you can be a part of. And that's in many ways the simplest, straightforward, although there's different flavors of ice cream in there. The second one is obviously joining with a financial sponsor. Now, what I would tell you on the latter is that's going to depend on the scale. It is, if you are in the kind of 2 to 5 practice range, you're much likely to be a better fit for someone that is kind of consolidating, a bunch of chains together. I'd say most financial sponsors, when they're looking to invest, they're gonna have their own box, quote unquote. What I mean by box is like their investment criteria, and there's going to be, oftentimes, minimum revenue or minimum profitability floors that they look for. And so, as you first think about evaluating, which one do you want to go with, which is either selling to a strategic or selling to a financial sponsor, you first have to ask yourself, like, am I a viable candidate for either, really? But probably first as a financial sponsor. And on that one, it would be pretty, I would say, below 3 million of profit. It's pretty unlikely that someone at a financial sponsor is going to lean in. And transparently, it's probably as you get north of 5 where the financial sponsor route may be more viable.
Yeah, so you then probably looking more at a roll-up strategy at that point, right?
Yeah, I think that's right. And so, which gets into this, like, the kind of questions I laid out, because not all, each consolidator has different things, right? They offer offer different opportunities. And what I would tell you as you kind of go through these, I'll hit the ones that will seem a little bit more straightforward at first, which is like, what will happen to my employees? And as you think about that one, like, the default situation, right, is they're going to want to retain all of your employees. Like, this is a business that obviously requires practitioners to provide care. And so, almost always the expectation is, gosh, we're not going to be changing the people. That's the starting point. Now, where this gets into a little bit different is probably when you get outside of the practitioner itself. And so if you have a multi-clinic operation and you have, for instance, a regional administrator, that may be a different question, because those in these larger chains may already be centralizing a lot of things. Like, for instance, they may centralize scheduling. They may have a centralized call center. And so that just may be a choice they're making. And so while the staff at the clinic level is going to be very protected, when you get above that, they may or may not keep those individuals. And that a little bit depends on the company. And I'll give you the example of, if you own 5 clinics in Chicago and somebody that has 20 clinics in Chicago is acquiring you, they're probably not going to keep the regional administrator. If someone in Chicago has 20 clinics and they want to buy 10 clinics in Oklahoma, very likely they're going to keep the person that's kind of working across all 10 clinics. And I share that only so that you can think a little bit about, hey, like, who's acquiring me? Where are they today? What does that mean for not just my clinic level staff, but also my staff that that are across all the clinics? And so that's kind of number one. On number two, on the patient side, it's an interesting question. Every one of the large players in the space is very, very focused today on driving great outcomes, and partly because they understand that that's how ultimately they have better conversations with the payers, right? Is because they're driving improved outcomes. And so they're all very focused on it. And at least theoretically, if someone is really focused on outcomes, they should very much care about treating patients in a responsible and a caring manner, because they want to drive referrals and they also want to drive great outcomes. But you will have to ultimately evaluate, hey, does the person acquiring me, do their values line up with it? Do they think about clinical care in the same way that I do? And this is just a learning for me over the years, which is, I've been into many clinics in my life where there may be slightly different ways in which that person is treated, but each of them get to a great outcome. And so you'll have to go evaluate that and see if that's what you're comfortable with. But I generally view kind of the larger players as being on the edge of figuring out, like, what are the best practices to drive great outcomes for patients. And so that's kind of number one and two on the patient and the employee side. And I think that leaves us kind of with the two others, which is, what does this mean to me? And what is the valuation? How much money do I make? And in some respects, those go together, because valuation hinges on a few different things. Yes, of course, your level of profitability matters. That's ultimately what people will look and think about what you're valued on. But as an example, are you looking to retire is kind of question one when you start. Because if you're looking to retire, you're ultimately looking to sell 100% of your business. And, I would say that will probably put a slight damper on your valuation, right? It's not material, but a little bit. In part because if you're not looking to retire and you're willing to retain 20 to 30% of the stake going forward, you're showing to the company acquiring you that you believe in this and that you're going to be a part of it. It also, from their perspective, it does something else, right? It keeps you bought in, and you've run a great clinic to this point in time, and so there's a keen understanding that healthcare is still a cottage business, and what I mean by that is healthcare is local, and so you understand how to have built a good clinic, and while they want to bring some best practices from their perspective along and would like you to help implement some of them, they still know that you've built a great following and base, and you staying around and keeping 20-30% matters. It also gets into this piece of do you likely already take some sort of distributions in your business, and being able to keep that stake. Many of these folks, not all, but some, will allow you to take distributions in accordance with your 20 to 30% ownership in the business. So while you're still getting paid your salary, you're also getting that distribution piece. And so it's just a consideration, a little bit of like, how much are you willing to leave in, and do you want to keep working? And it may also be the case that maybe you want to retire, but you're also just willing to keep 20 to 30%. Maybe you have someone in your business that's going to step in, like a number two. And that's kind of the way I would think about that piece. The other kind of factor is employment. And what I mean by that is, how much is the company acquiring you going to kind of force fit their model onto you? Some of the larger folks have brands that are really, really strong, great brands, and that helps drive a lot of referrals for them. And so the expectation when they acquire you is that you're going to represent that brand. And then there's others that are more in what I'll call like a fragmented model, right, where they do own a lot of clinics, but they don't expect you to kind of convert, quote unquote, to the brand. And so you have to kind of work through like, hey, is that something I'm comfortable with? And both of them have real pros and cons.
Yeah, and you have to, I think you have to think about that hard, right? Because you're coming from, if you've been an owner operator for 20 years and you give majority stake to an organization, right? You have to be really comfortable with what your role is within that organization, right? Moving forward. So it's certainly a key aspect to how you're gonna work and live and be involved, for whatever period of time that you're willing to sign up for post transaction.
Yeah, and that's a great point. Like, hey, what duration of time am I willing to sign up for? And particularly if you're rolling equity, you'll often see, a certain time commitment you have to make, and then there may even be a way to kind of pre-plan, with the company that initially acquired you, a next exit. And so that's just something to think about when you're working with people.
Yeah.
But look, these are kind of all different factors, right? And the last one that we that are kind of more qualitative, I should say. Now we're getting to like the quantitative one, which I think is an important one for everyone. Is, hey, like, what am I going to make here? And in part because this is in some way your life work, right? And I think everyone who's ever started a business feels this way, where it's like, it's your baby, and you do care about where it goes. And so on the valuation piece, what I would tell you is, first, like, the size of your business is ultimately going to impact your multiple, right? The larger you are, likely the larger the multiple is. And then more importantly is, as you go through that process, you really need a great lawyer, probably number one, as you go through. Like, if you think you're going to get a deal done and not have a good lawyer, you're going to be in for a pretty painful ride, because you're going to be negotiating. Things you shouldn't have to negotiate. And I want to define what I mean by a good lawyer, because I think we all know a quote unquote good lawyer. What I mean is, hey, I've sold north of 15 businesses that look like yours. And so it's just like in the last year, they probably sold 2 to 3 practices that look like yours. That individual then understands what is normal. And I think the second question is, do you hire a bank or not hire a bank? And I think this a little bit depends. The pros of hiring a bank is you kind of get to do a market check and figure out, like, hey, is the price I'm getting fair? What I would say is the con of it is, banks are there to optimize getting a price, but they're not often there to optimize getting a partner. And so if you're selling 100%, almost always you should hire a bank. If you are not selling 100%, looking to roll, like, spending the time to actually understand who you're going to be working with is pretty critical. And sometimes banks don't allow you to do that as well. But it's and then the last thing on the banker side is usually it's also a size question. The larger you are as a practice, the more likely you are to hire a bank, versus the smaller, the less likely you are. So look, hopefully that gives you a little bit of color on all of these.
Yeah. Hey, John, curious, this is not something that you just all of a sudden decide overnight, I'm going to go sell my practice, right, or business, right? Any guidance or counsel on how long in advance you should really start thinking and planning about the process and going into a transaction, right? So, clearly I would think that if you're going to make, or if you make a decision to say, I would like to have some kind of exit, whether it be to your point, 100%, or I want to roll over 30, 40%, there's got to be, there's a lot of planning that goes into that, right? And you can tee up your business and set things up and structure it probably more appropriately. But any guidance on timeline to do that and to think through that?
Yeah, it's a great question, and I don't have a wonderful answer, but I'll try to do my. So I am when people think about selling, I would say generally for smaller businesses, so sub $5 million of profit, it's a little bit more organic than that, right? It's just like, hey, we've had folks reaching out to us, and I personally have gone through the thought process to figure out that, hey, either I'm ready to take some chips off the table, or I'm looking to step out of the business, or bring on a partner, because maybe I want to bring a partner honestly because I got 3 clinics and I want to get to 10, and I know that bringing on a partner is going to help me get there. And I think that's more of a mental journey, and more to figure out like, what do you want to do, and that's going to take however long it takes. I've seen it take 3 months. I've seen it take 5 years. But once you get to the point where you're like, gosh, I kind of know what I want, then I think it's actually relatively quick, right? In some respects, like I bet there's not a single person listening to this podcast in some way that hasn't been reached out to at some point by one of the large guys, and so it's just a matter of do I want to take that call, and there's a question for them, right? Of like, hey, do they want to engage? And I think you've got also the piece of like, you can reach out to 3 or 4 and kind of be able to run a little bit of your own mini process with them, in part because you're doing discovery on what each one of those partners looks like. And so and then on the, if you're really large and you're thinking about, prep, that often means like, trying to think through like, hey, how do I optimize profitability before an exit? And if you're doing that, that takes, you're probably well north of 5 of profit, maybe closer to 10 of profit. And in that situation, it's probably being done 18 months in advance, because you need to prep for 6 months, then implement those changes for 12 so that you can get credit.
Yeah. Yeah. So not every glove fits every hand, so to say, correct?
Yeah, I think so.
Yeah.
I mean, it's a little bit depends on each individual case.
Yeah. Yeah. Well, John, this is a great conversation, and I thank you so much for joining us today.
Yeah, look, it was my pleasure. Thank you so much for having me on here. I couldn't be more thrilled. And
absolutely. Well, I also want to thank our audience for tuning in to the Therapy Matters podcast, your one-stop resource for expert insights and advice on everything therapy and rehab. We look forward to seeing you on the next episode. Thanks so much and have a great day, guys.
Thanks for listening to Therapy Matters. Do you like the podcast? Give us a 5-star rating, subscribe, and tell all your friends about the show. Want to be a guest or know someone that would be a great guest speaker? Contact me at allison.jones@raintreeinc.com. That's allison.jones@raintreeinc.com. Therapy Matters is brought to you by Raintree, Therapy and Rehab's favorite EMR. Raintree is the only all-in-one therapy EMR delivering a complete and seamless end-to-end patient journey, from first contact to payment to patient retention. To learn more about Raintree, visit us online at raintreeinc.com.